And now, the survival show that once survived a French film. In this episode, we sit down with Holly and Nate of the Dollars and Nonsense podcast. They're going to share with us some insights about things to avoid doing with money and things maybe you should be doing with money. Howdy, and welcome to In the Rabbit Hole's Urban Survival Podcast. This is episode number 193. I'm your host, Aaron, and you are in the rabbit hole, safe and sound. Holly and Nate, welcome to In the Rabbit Hole.
Great to be here, Aaron.
Really excited to talk to you today, Aaron.
Well, and I'm excited to talk to y'all because we here in the Rabbit Hole don't talk about money often enough, and it is so like some people have a love-hate relationship with money. Some people hate money, some people love it, and everything in between. But it is so crucial to survival in and being prepared in our everyday, day-to-day lives. Excluding the zombie apocalypse, there's pretty much not a time where money is not going to come into play in whatever shape or form it's in. So, but I think today we talked about we're going to do 3 things people should avoid and 3 things people should do to tend to their money.
It's funny that you said that, Aaron, how you don't talk too much about money, but yet how crucial it is.
Oh, yeah.
And, you know, one of the things that we like to talk about as well on our end is it used to be that nobody would talk about sex around the dinner table. You know, that was the big no-no. And nowadays you find that no one ever talks about money at the dinner table. And it's kind of, now it has that same stigma. You don't tell anybody about money. And it can be a stress point. You're exactly right. So hopefully today we'll be able to share some tips that, you know, can help people be prepared and less stressed about it, and maybe even learn that it's okay to talk about it.
So now y'all also have a podcast that is launching this week, and that's really exciting. So y'all are from the Dollars and Nonsense podcast. So Nate, let's jump on in. Let's start with number 1 on your avoid list.
Sure. The first thing that if you really want to be prepared and protect yourself financially, as you were kind of mentioning, is you really want to avoid retirement programs like the plague. And I know that may sound to some as kind of new news because you'd say, well, Nate, doesn't everybody in some sort of retirement program? And that may be true, but one of the things that if you're prepared, we've seen things around the world where retirement programs really do not provide a security or anything that you'd really want it to be. And I don't know, Aaron, I don't know about you, but I know as an entrepreneur, probably the last thing on your mind is really, man, I really got to get more money into my retirement program.
Yeah.
I could be wrong.
Yeah.
But it's more of a in the box thinking. Mm-hmm. And, you know, the motto of our show, which you just mentioned, Dollars and Nonsense, is if you follow the herd, you will be slaughtered. And a lot of times you find that true. And so that anything, this is the big idea on my mind, is that anything that the government sponsors, it allows itself to change the rules and or confiscate.
Yes.
And that's part of the retirement program world. You've seen in other countries, Argentina, prime example, where the government needed to fund its Social Security. So it wasn't called Social Security, but that's what we know it as here. Because it went bankrupt, and where do you think they went? They went to the private pension programs and retirement programs in the country and turned everyone into a single-payer system. And I'm sure everyone on your show realizes that Social Security is not in the best shape. Probably going bankrupt at the state of things are, and I think it's like 2033.
Yeah.
They say it will be bankrupt. I wouldn't want to be sitting on government-sponsored programs when, you know, push comes to shove and the government needs some money to uphold their handouts. So that's one of the, you know, big worries I have, especially for your listeners about retirement programs. They also penalize you for using them. So unless you follow their rules, you can't actually use them without having to pay a penalty. And so that's you never put your money in a place where you're penalized to use it. It's a very dangerous place to be, and they can define the penalty and can change it because they're in control of it. So that makes it very illiquid, and they're many times very volatile because they're put into the market-based instruments. And a lot of people in my neck of the woods are a bit worried about another market crash. It's been a little while since our last one, and I'm a little bit worried that it's mainly the Federal Reserve pumping money into the economy that has caused the growth of the market, you would say, since then. And if it's like a house of cards.
Yeah, totally artificial.
Yeah, I mean it's not real money. It's just monopoly money. So there's a lot of worries that we have, and I'm sure Holly would agree, in retirement programs and how if you're really looking to make a difference and you're really looking to prepare for the inevitable of certain things that may happen, they're probably the worst place in the world to put your money.
Yeah, it's hard to play. It's hard to play the game with the game creator who gets to make up the rules as they go.
Exactly, you're exactly right. And so if you're not in control and the government's in control, then it's back to being a servitude mindset. And subconsciously, it kind of puts you in the position where you're doing everything just for the government handout. And what's interesting is they give you handout to behave the way they want you to behave. And that's, put you into the mold. And the creative people, the innovative people, the successful people, and the people that survive through potential difficulties and economic crises and things like that are definitely not the ones doing what the masses are. Because if the masses were doing the right things, then there wouldn't actually be an economic crisis because everybody would be, there wouldn't be a crisis. Everybody was in a position that some are during that time frame. So, that's one of our first thoughts on, one of the best ways to protect yourself financially is to try to find something different and creative to do with your money that is beside what the masses are doing and beside what retirement programs are doing.
And I want to make just a point there, Nate, too. It's not just that you get a penalty to use your money, but they also tell you the time frame of when you can use it. So there's penalties on both ends. If you haven't used it all by that time frame, then you get a penalty as well. Well, what if you live past that time frame?
Mm-hmm.
So,
yeah, you have like up until 59 and a half, you're penalized if you use it. And then by the time you hit 70 and a half, if you don't start using it, they'll penalize you. So you have this, you have a 10-year penalty-free zone.
Yeah.
and then if you don't follow their rules, then they will penalize you. So then you gotta, it's sad what people are doing.
Yeah, it's a bit of a rigged game right there.
It can be.
Yeah.
It's rigged. I'm telling you. IOUs are in those retirement programs right now.
Yeah, and Wall Street knows what they're doing. They've got all the contracts with the government to get their hands on your money. They love retirement programs. Money managers, Wall Street, people like that, because locks up the average person's money. And so they get their fees and everything on it for years and years and years, and you really don't have much of a say in it. It works well for the people in power, that's for sure.
What's another thing to avoid here?
Another thing to avoid is the belief or understanding that, as we've been taught in our education system and throughout college and university, that numbers are the same as money.
Oh, that's
And
interesting. Do tell.
I will break it down a little simple. We're taught 1 + 1 = 2.
Mm-hmm.
Okay? Simple math, no difficult. But $1 + $1 does equal $2, but it's not the same $2 in the future. So just like Nate was talking about the retirement programs, they will promise you you'll have the same money. Take that money, just like a CD in a bank, and deposit your $100 here. And the only way you earn money is to leave it sitting there. Well, your $100, whether it sits there for 1 year, 2 years, 3 years, or 5 years, is not the same $100 that you initially put in there. It doesn't buy the same thing. It doesn't have the same buying power. And so really, numbers are not the same thing as money. One is something that is just mathematical. The other one has to do with inflation. It's worth less in the future. And really, if we believe that money is the same as numbers, then we're just lying to ourselves. And we're believing what they've taught us to believe, that it's the same in the future as it is today. And we all know that money in the future is not the same as the money it is today.
And that definitely makes sense, as you kind of mentioned with inflation for sure. But, people actually go out and trade currencies. People know that $1, is different than £1, is different than, I'm glad to know, as you know, Holly, be educated, that numbers and money are not the same because, $1 in certain countries buys a lot, doesn't buy as much here. There's value placed on tradability of different types of money, where it's more of a commodity now than it is a number. So yeah, you're exactly right.
And that money can change overnight,
Exactly.
instantly. And so you might go to bed at night and, hey, your dollar was worth a lot more. And then you wake up the next morning, you find out, what? My dollar that was equal to £1 is now only equal to half a pound in British currency. So it really depends on knowing what that is, that your money changes overnight, it changes daily, the transactions of that. And so if you believe that it's the same as numbers, you're going to be sorely disappointed when you wake up one day and there's no more money.
Yeah, and I think an extreme example of that, as what Nate brought up earlier, would be what happened in Argentina and even in Zimbabwe with runaway inflation and everything else, where I think even in Argentina, it was like hour to hour, the money was different.
Yes, one day you could buy $1 and get a McChicken, and the other day took 10, the other day took 100. Mm-hmm. So, and yeah, the same thing in Greece, and you see it a lot in African countries, unfortunately.
Yeah. Is this a concept that y'all find with like a lot of y'all's clients and stuff like that it is a simple concept that just kind of got drilled into people's brains, and even though they're smart people, it's just something that it got drilled in and they never stopped to think about, ooh, wait, in this instance, 1 + 1 does not equal 2.
Yeah, it definitely has been drilled in. And you talk to most financial advisors or different things, and they show you how much money you'll have in the future, and we overlook the fact that though 40 years down the road, that sounds like a lot of money. But is it really going to be those numbers that they share are not actually the dollars that you know of today? And so it's definitely been drilled in. It's more of a sales tactic, or can be, that they don't want you to realize that, oh, we're showing you this incredible compound interest spreadsheet, but what is, just as your money can compound, inflation compounds. Mm-hmm. And so what do you really actually have? Uh-huh. And not very many people in our industry really want to actually take a look at that, because they want the client to open their mouth and gasp, but man, I can have that much money. And it makes them feel good, but when you really, it's unfortunate to be a realist, but whenever you really look at it, it may not be. I mean, it's kind of deceptive, actually.
Yeah. And they don't say, what's that magic money amount? They say, what's the magic number you need to retire on? What's that magic number? We've been trained to associate number with money, because some people, if I have $1 million, then I'll have enough. Okay. But they don't say, what's that magic money? They say, what's that magic number? We respond with a response of money, a dollar amount. And so it's been ingrained in us for most of our life. I mean, when somebody says that, you respond with money, but you never translate that they never asked you the money amount. So you see this number of $1 million, not realizing that inflation and that change, if they actually broke it down to what that actually could purchase based on inflation in the future, people would be shocked.
And I think the biggest detriment to that style of thinking is then you believe you're going to be better off than you really are.
Oh, yeah.
And you believe that you don't have to put in very much to get exactly what you'll need, or to get more than you need. So you have this concept that, okay, if I need this much money, I only have to put in X amount into whatever this thing is, most of the time retirement programs or other things. And you have this idea that, oh, I only need to put in $500 a month. Well, a lot of times you'll come to the end of the life and say, man, I really wish I would have done more at certain times, because I thought I was going to have more, but man, the number seems big. Because I bet, Aaron, you would probably look back on your life, and as you growing up and as a kid, you'd probably never imagine that you'd be making the kind of money you are today. even if it's not that much in the grand scheme of things of what everyone else is making.
Yeah.
But it's just that number seems crazy.
Yeah.
And then you wonder where it all went. It's like
every day.
it's like, man, this big number is on my tax return, but I don't seem to have anything. And it's interesting how that works. How we think $1 million, back in the 90s, there's all these movies about becoming a millionaire.
Mm-hmm.
A millionaire nowadays is, anybody can be one. It doesn't mean much. So
yeah, and I think even a simple example of that is just the price of cars today. In the early 90s, my mother bought one of the first Jeep Cherokees that came out, and it was like $20,000 or $25,000 or something like that. And my dad was having a conniption. He was like, "You paid how much money for a Jeep?" Because that was a lot of money for a car, especially a domestic car back then. And today, what does a Jeep Cherokee cost now? Like they're almost like $80,000 or something.
Yeah,
like
if you
that?
get it souped up the way you want it.
Yeah. I mean, it's just insane. Yeah.
Or they have that base price now.
Mm-hmm.
Base price of the car. I got my first car, that was purchased actually in 1992, and I thought I was doing really good, brand new car, and it costs about $15,000, and that was, oh wow. And now, base price is $35,000, $40,000. You want an SUV? Look in the $50,000 to $70,000 range.
Yep. So now, and I think another big one that we had talked about before the show is the myth of saving 10%. And that's almost like written in stone kind of stuff that right there. So tell me about that.
Well, yeah, I think, from my viewpoint, and Holly, you can give yours, is we get taught to, save some money, save 10%. But if you look at the average American family, even if you can manage to get to that point, which, the average, I think, is 5.8% or something like that is the actual savings rate in the country. So it's not even to the point, the average people might think 10% is great, but they're not actually doing it, which is sad. But saving 10% is great and all. But the issue that we find with most people is that you may be saving 10% and you're trying to get the highest rate of return on that money. But if you take a look at your car loans and your credit cards and your mortgage and your student debt and maybe some business debt, and you look at all the debt you have, easily you could be spending 25% to 35% of your income on interest for all the various things that you finance. Not even the principal, we're talking about the interest. And yet you're trying to save 10%, and you're thinking that if you would learn to cut out some of the money that's just leaking, then you'll be able to be much better off than your focus is on to get a high rate of return on the savings. And it can be more of a volume approach just by changing really who the banker is in your life, who's in control, and things like that.
And I think, too, the other thing is if you put it just in the simplicity of not in even percentages, and you just look at that as if you were saving 10 cents of every dollar you made, but 25 cents to 35 cents of every dollar you make is going to somebody else in interest, it really doesn't matter what the rate of return is, because your 10 cents is never going to equal the 25 cents to 35 cents that's leaving your pocket for every dollar you make in your lifetime. So that rate of return isn't as significant. And to get a high rate of return, you normally have to take more risk with your money. And what you're seeing is people that are taking the risk with their money are often losing it. And if they're saving the 10%, they're putting it right into either a retirement program like we've talked about, or into their bank, or into a CD, or something like that. And they're losing control once again of the money. And like Nate said, that the bleeding has to stop at some point. And so even if you can just take and learn how to stop that 25 to 35 cents leaving your pocket and going to somebody else and bring it to you, it will help you in the future and today.
And you don't even need to get a high rate of return to build wealth.
No.
I mean, that's what everyone's shooting around to try to get the Dave Ramsey 12% return in mutual funds or whatever it is. And if you would just simply close the leaks, you really don't have to get an incredible rate of return and take a lot of risk on the new startup stocks and things that jump out to try to make up for how much is leaving if you could just learn to keep it.
Yeah, what was the old expression? A penny saved is a penny earned?
Yes.
Exactly.
Mm-hmm.
And so many times we get caught, and that actually almost brings us back to the numbers in money, which is talking about the rate of return. If your rate of return isn't what you hoped it would be or what it was projected to be, then then you probably didn't put in as much as you should have, and you're way less than you really wanted to be in the future. Much easier to deal with being in control instead of just gambling. It's much easier to build wealth that way.
So now we've talked about three things there to avoid. Moving on to three things people can do, and I think you had an interesting one that we were talking about earlier, which was like tools of the rich, and one of them is from I know, like I hear Susie Orman, who I absolutely cannot stand, talking about it often about like buying term. Can you talk us through that for a bit?
Really, what Susie Orman says is buy term and invest the difference. Okay. And many of us, we see the advertisements on TV for only $14 a month. You can have $500,000 in death benefit. Okay. And so with that money you're supposedly saving, you're supposed to go take that and invest it. But here's the kicker of the big buy term and invest the difference, okay? The only way you win in life by buying term is to die. How exciting is that in your life?
It's not very exciting.
Yeah. No, okay? So I'm going to buy term, and the only way I'm going to beat the insurance company is to die. It gives me no cash, though. The $14 a month is gone, given to somebody else. There's no cash. You don't have the $14 to use. And the only thing you've provided is that if you die in this time period, you are going to pass on money to your family. Now, money is important in wanting to leave a legacy for your family. I totally understand that. But ask yourself this one question. How often do you actually think about death in a day versus money in a day? We think a lot about money, and you need to be in control of your money and not just be putting it in something that the only way you succeed is by graduating from this earth.
So what's an example of that?
As far as tools of the rich goes, and if you think about it, what do the rich buy term insurance, the wealthy people in the world? They actually don't. And that's what's really, really we find interesting is something that the pundits or the professionals tell us to do as we're on the middle class and things like that. But the wealthy, they don't buy term insurance. They always buy whole life insurance instead, and yet we're told that it's not a good place for money to go. And so that's what we like to say, tools of the rich. They can actually use the same tools that we use. They might just do it differently than we do it. So as Holly was saying, many times when we think of life insurance, we think of a death benefit. But who do you think the biggest buyer of whole life insurance in the world is, Aaron?
You'll have to tell me. You got me stumped.
Okay. I didn't remember if we talked about it before, but yeah, it's banks. Banks own more life insurance than anyone else in the world. And in fact, they own so much, it's called their own name. It's called BOLI, B-O-L-I. It stands for bank-owned life insurance. They even got their own acronym for how much they buy.
Wow.
And Bank of America has over $20 billion in cash values, which is actually more than all of their real assets, their properties and the various things. They have more in life insurance than they do in all of their equipment and real assets.
So are they buying up the policies themselves, or so what? I'm confused.
Yeah, they buy a policy on whoever they can buy it on. It gets really interesting. They own policies on pretty much all their mid-level management and up. So, of course, life insurance has to be on a life. And so they're out there buying this BOLI on as many executives and upper-level management that they possibly can. They put as much money in there as they possibly can for very specific reasons. But what's amazing is that maybe they could be stupid and wrong, and they really shouldn't have done that the way we're told with conventional financial guys. Or they could just simply know something that we don't know about how to use the tool. And that's many times is the case for you and I, that they're probably just doing something different than we are with it. And so they buy this thing like crazy. Wells Fargo, Bank of China, Bank of Japan, they own life insurance. And you'd say, what on earth is a bank doing owning life insurance? And they actually use it because of the benefits of it. And we can get into that as well, Aaron. But just basically, they're doing something that we're not doing, and yet they're the ones with all the money.
Mm-hmm.
And do you think as Holly was saying, do you think they're buying those policies for a death benefit? Or do you think they're buying them for cash?
Knowing if it's a bank, it's most likely cash.
Yeah, what would a bank be doing hoping that their employees die?
Yeah, that's kind of dark, yeah.
I mean, they're not that crazy. So that's the thing about a whole life insurance policy is you can actually design them. That's exactly what Holly was talking about, that instead of designing a policy that's focused on death benefit, you can actually design a policy that's focused on cash value. And that's exactly the way banks do it, is they pretty much stuff all the money that they pay into these things into the cash value of the policy. And there's very little risk involved. They can't go out and just buy stocks with it's called tier 1 capital. That's the capital they have to keep liquid in case of a run on the bank or things like that. And it kind of determines how much they can lend out, because you and I know that they do fractional banking. So they have to have some sort of foundation to know how much can we actually have out in loans before the regulators come and get us. That's based on how much capital they have in tier 1 capital. And so they actually use this like you and I would use a savings account or a checking account. I mean, that's their liquid money. And what's amazing is it grows. Life insurance, a lot of people don't know this, grows by 4 to 5% a year without having to take risk in the market. And there's no taxation on the buildup.
So how does it grow?
It grows because, I guess I could ask you this as well, Aaron. What is the difference between an insurance company and a bank? It's really just the sign out front.
Oh, interesting. Okay.
They're in the same business, actually. Insurance companies and banks are in the same business. A bank takes money from us on deposits, and then they make loans with our deposits to make a profit.
Mm-hmm.
And so we put a savings account at 1%. That's how much the money costs to the bank. It costs them whatever savings account rate they're paying us. And they lend it out to the guy who wants to get a mortgage at 5%, and they keep the spread. And that's really how an insurance company works too. We pay premiums, and they've got to go put the money to work. They're not just going to let it sit someplace.
Mm-hmm.
So with whole life insurance, they know you're guaranteed to die someday. So if you're paying this premium and you're putting money into this policy, they know they've got to go put it to work and earn money, so they will one day, because they know they're going to have to pay out a large death benefit. So they got to build up the pool of money to get to it. And so they actually do that mainly through loans. They do bonds, mortgages, things. They're essentially a bank, but they don't do, individual loans. They do big blocks of money, in the financial world. So that's actually how it does. So a bank puts money into these policies, and it counts as tier 1 capital to them, so they can actually re-lend that money. But while it's there, the insurance company is also lending the money out. And so as the policies are growing, that's how, in other words, the insurance company will lend it out at 4 to 5%. But at the end of the day, unlike a bank, many times you'll want to work with what's called a mutual life insurance company, Aaron.
Okay.
Because in a mutual life insurance company, it's not owned by stockholders or shareholders. It's actually owned by the policyholders. So at the end of the year, unlike a bank where you put your dollar in, it earns 1% and the bank lends it out at 5% and keeps the spread, the insurance company takes the same money, lends it out to the same people, gets the same interest rate back, makes a profit, and says, all right, we got to go send it to our shareholders. The issue is they don't have any. So then they actually send it back to the policyholders in a form of a dividend. And so your policy, essentially, it works like banking, but instead of being just a depositor in somebody else's bank, you actually plug in as an owner of the bank itself. And you can use the cash values that are building just like you're currently using a bank account. So that's what we mean by tools of the rich. They have it, instead of using a life insurance policy for a death benefit, they actually use it like their own bank account. And they can even make loans based on the amount of money they have in BOLI. And that's one of the things we teach, is how to do it the same way for yourself.
So, and that's interesting. And I know that was one of the things that we talked about, was what y'all do is referred to as infinite banking. And I do want to acknowledge first that the first time I heard about it, I was like, this is extremely, no, I wouldn't use the word extremely, but definitely like this is fishy. Like, and I think, and you and I, as we were talking about before the show, is like one of the reasons it's like, it's anything outside the box. So I guess let's speak to those 2 points about what is infinite banking. And you had such a great way you put it about anything outside the box being fishy to people.
Well, yeah, and that's what we talked about, Aaron, in the very beginning, how that was your first thought whenever you heard about the infinite banking concept. And as I said, just like with anything financially, if anyone tells you something new financially, your radar, suddenly starts beeping that there's some, scam about to be told, because you're kind of wondering, why have I not heard about this yet?
Mm-hmm.
That's the first thing that beeps up. So as soon as you hear something new, something comes on your radar that you haven't heard before, you got to put the defenses up, because there are scammers out there. But many times we always try to shun things that we didn't know before or that don't fit our mold. And so, yeah, that you're not alone there. That many times that the very first thing that happens when someone hears the term infinite banking is they say, "Oh, here comes the snake oil salesman."
Mm-hmm.
But it's because it's something different. It's not difficult to grasp. It's just different. And so there's a difference between the two. And so it is different from what the normal people are taught to do. But as we say, if you follow the herd, you'll get slaughtered. If you want the same result as everybody else, you'll do the same thing as everybody else. The only way to get better results is to do something different. And so it is different, and there's a learning curve to understand this whole infinite banking, how to use policies like banks do, and how to use them like a bank account is a brand new understanding for most. So you can definitely have some resistance to that.
And also, as the middle class individual, lower class, we also think it's a get-rich scheme, that the powerful, the rich are doing it, but we don't have access to that yet. Like we've talked about, we have the same products to use, but we've been taught different methods, like buy term invest, the difference. But if the rich are buying this, and if banks are buying it, and they're in the money business or to generate money, shouldn't we learn to mimic what they're doing? And really, banks do with your money on a daily basis, you can do with your own money through infinite banking.
So in a nutshell, I think we already kind of covered it, but in a nutshell, what is it?
The simple way of looking at it is that it is a life insurance policy that is purchased through a mutual company. So then you get the benefits of being a shareholder, and there is both death benefit and cash value in it. And you are using that policy to generate income because it gives you what Nate said, a guaranteed growth rate that grows tax-free, but yet you never lose control of your money when you're putting it in. So you can give them your strong dollars today and still be able to use those dollars today and in the future.
Give me a couple of examples. How does somebody use this?
Sure. So, you can use it. Really, the main thing about infinite banking, many people know that a whole life insurance builds cash value. And that's not something new. And that many people know that life insurance policies grow tax-free. And that's not anything really new. The new idea that this kind of concept brings is mainly how, as you kind of ask, Aaron, how to actually practically implement. And it's a change in the way that you think, from having a policy that's just sitting on the shelf to really treating it like a bank account. So one of the ways we constantly use our policies is just like we would normally a bank. So let's say I build up a policy and I've got cash value and I need to go buy a car. Many people would simply go finance their car purchase from somebody else's bank, or maybe they pay cash for it if they've got it saved up. Well, one of the ways that we do it is, let's say, hey, let's actually take the money, we'll borrow the money against our life insurance policy. We'll pull out our cash values and buy the car. And then we'll simply pay ourselves back the same way we normally would have paid back a bank. And so at the end of the time period, you'd actually have all the money back for the car. Plus, because the policy is guaranteed to grow, you'd actually not only have all the money you put in, but also all the growth from those dollars. And so you've got all the money back for the car plus the car. with the same dollars that you normally sent to a bank to pay for the car in the first place. Plus, you have a tax-free profit from financing the car through your policy that you can now utilize to go buy the next car and so forth. So it's essentially a brand new way. We try to run everything, whether it's, financing cars or paying for education or weddings or just a vacation, all the way to owning your own mortgage through your policy and using your cash values to fund it. It's essentially a focus that's on banking and how to take control of how you finance purchases and making money off those, instead of the old way, which is, okay, I'll use a bank for all of that and I'll leave my money in my retirement account. So it kind of merges the two.
So you borrow against it like a checking account, and you say then you repay it. Do you literally mean like you write a check back to your own insurance policy?
Exactly. So let's say you had $25,000 of cash value and you needed to buy a car and it was going to cost you 25 grand, just for an easy number.
Uh-huh.
You could pull all 25 grand out of the policy, but part of the banking strategy would be, okay, so we've got the car paid for, but if you didn't have the policy and you had gotten the money from somebody else, you would have had to make a monthly payment to them. Well, let's treat ourselves exactly the way we would normally have treated a bank, and let's pay back the policy the same way, just to fill the cash values back up so that we can use it to buy the next car. Because if we didn't put money back into it, how are we going to finance the next car or the next vacation or whatever it is? Does that make sense?
Yeah, that makes sense. And so to start it, you've got to, but I mean, I guess to start it, it sounds like, and correct me if I'm wrong here, you've got to put the money in the first place.
You have to put the money in, but if you think about it as even that you're just saving money,
Mm-hmm.
then you're making that deposit into your own bank account. It's just that it's in a with a life insurance company,
Mhm.
and that money's being deposited into your policy.
Okay, so you essentially at the beginning you start using it sort of like a savings account.
Yeah.
Okay,
you-
and then
Yeah,
you
that's
buy
what
it.
we're trying to say, is that it becomes your new bank account.
Oh,
Yeah.
okay. Yeah, I was just wanting to make sure I was clear on that. All right, and what, and I guess that begins the question of, because it is a tool of the rich, but it's also like where is the cutoff for people? Like if I'm some kid fresh out of school and only making like 30 maybe to $60,000 and just getting started or whatever, and then you've got different levels. And this is what y'all do in your day job aside from your new show. Where is the point financially that it starts making sense for someone to do this? Or is it something people do early on and kind of build up? I mean, where does that go?
I mean, it's really for everybody, and this is something we say, whether you make $10 an hour or $10,000 an hour, everybody ought to become their own banker. Everyone ought to know this process, because no matter how little of your income or how high your income is, people are still going on vacation. People are still in credit card debt. They've got student loans. They've got a mortgage. They're borrowing money to buy cars. People are still doing banking. They're just not doing it the way that you really should be, or the way that we teach you to do it. So whether you can just put in a couple $100 a month to build your policy so you can pay off your credit card, that's a step. So you can pay off your student loans, that's a step. So you can pay off the car loan. So really, there actually is no, minimum. We've worked with missionaries who are in other countries who are putting in like $150 a month and using it to finance a lot of their missions work. And then we've got all the way, to the corporate executives and business owners and things who are putting in multi-million dollars a year, and really everything in between.
Well, very cool. So tell us a little bit about your show. You've got a new show that y'all are launching this week, and I'm really looking forward to it. What is the essence of y'all's new show? I believe the name is Dollars and Nonsense, right?
Yes. The essence of the new show is, like Nate's done the tagline several times, if you follow the herd, you will be slaughtered. And really the essence of that show is really to educate you on money or myths and things that have to do with dollars and make sense out of it versus being listening to all the nonsense.
Yeah, we try to make it really practical and just have practical strategies and things like that really may be outside the box for most people with how they deal with money, whether it's how to deal with mortgages, how to deal with debt that you have, how to deal with paying yourself first. I mean, really just outside the box things to do to accomplish objectives that most people have. And it may even be better than what you thought you could be doing just with the same resources you have available to you.
And the Dollars and Nonsense podcast, you can get more information and stuff like that with it by visiting livingwealth.com/podcast. And that'll explain more what Dollars and Nonsense is and our launch date and information like that. So you can be listening and decide, do you want to follow the herd and be slaughtered? Or do you want to do that outside the box thinking and really discover how to be financially free?
Awesome. What was the website address one more time?
livingwealth.com/podcast.
Awesome. Well, guys, thank you so much for coming on today and sharing your thoughts and wisdom and some pretty neat information, I think. I really appreciate it.
Thank you, Aaron.
Oh, our pleasure. Thank you, Aaron. Yeah, it's been great.
Show notes and links to today's guests are available at intherabbithole.com/E193. Consider supporting the show. Visit itrh.net to find out how the ITRH Armada membership benefits you. Do it today. Again, that's itrh.net. And with that, we wrap up episode number 193 from the Lone Star State. Till next time, stay safe and sound.